Welcome to this explainer. If you've ever felt completely overwhelmed by the sheer volume of investment choices out there, trust me, you are definitely not alone. Today, we're cutting through all that noise. We're going to take a massive data analysis of Fidelity's investment options and distill it down into a high-stakes tournament to find out what actually performs over a full decade.
So let's just dive right in with a question that really sets the stakes for our whole journey here. Out of all the exchange-traded funds Fidelity offers, which single fund had the power to take a $10,000 investment and completely supercharge it into more than $80,000? No spoilers yet, but we're going on a strictly data-driven exploration to find out, and the answer might genuinely surprise you.
Now, to find our ultimate champion, we had to establish a pristine starting line. Using Investing Pro data, we initially looked at Fidelity's total roster of 94 funds. But as any good data detective will tell you, you have to clean your inputs. So we filtered out the cross-listed funds. Those are just the exact same funds trading on different exchanges. We definitely didn't want to run the same fund through our test twice. That rigorous filtering left us with our true primary list, 58 unique contenders.
Okay, to make this fair, we needed a core rule for the tournament. And I love this because it brilliantly illustrates our whole philosophy. 1 year can be a fluke, but 10 years, that's a pattern. We are strictly relying on a full decade of history to crown our winner. Why? Well, because a 10-year window catches the whole shebang: aggressive rate hikes, sudden market crashes, painfully slow recoveries, and those massive tech booms. As we're going to see in a minute, short-term, 1-year returns can be incredibly deceiving. To make this whole experiment grounded and, well, relatable, we're placing a hypothetical $10,000 into each of these 58 funds. This just gives us a solid, real-world metric for growth, letting us clearly see what that exact same starting pile of cash would look like today after braving 10 years out in the wild market. Moving into round 1, bonds, active and dividends. Let's put these traditional safe plays to the 10-year test and see exactly who survived.
First up, the bonds segment. Now, we know bonds are typically meant to preserve capital, right? Not necessarily grow it. And wow, the data proves exactly that. The winner here was the Enhanced High Yield ETF, FDHY, which turned our 10 grand into just over $15,600. Not bad. But look at the loser, the FCIG fund. Over 10 years, $10,000 became $10,080. Literally $80 of growth over an entire decade. You could probably find that much change lost in your couch cushions. Aggressive rate hikes just absolutely dragged down existing bond prices and completely stalled their momentum.
Now this next one kind of flips the script on a golden rule of finance. For decades, we've been told that passive index funds always beat actively managed funds, mostly because of lower fees, right? Well, the Fidelity Blue Chip Growth Fund, FBCG, completely broke that rule. Despite charging a higher 0.6% fee for active management, it delivered an impressive 11.13% average annual return. It actually beat out the passive indexes, proving that sometimes you really do get what you pay for.
And this right here perfectly illustrates the sheer volatility hiding inside seemingly stable categories, like the dividend sector. Take the FDV High Dividend ETF. It was our undisputed 10-year champion. But if you look at just the last 12 months, it completely fell off a cliff, dropping all the way down to 9th place. Meanwhile, on the flip side, an Emerging Markets Quality Income Fund, FYUM, sat at the absolute bottom of the 10-year ranking, but suddenly rocketed to number 1 in a single year, thanks to cheap valuations and strong local currencies. It's the perfect reminder of why our 10-year rule is absolutely crucial. All right, round 2, the factor fund filters. Let's take a look at how these highly targeted market bets performed. Before we get to the numbers, though, let's quickly define the jargon. What exactly is a factor fund? Well, instead of just blindly tracking a broad index like the S&P 500, a factor fund selectively picks stocks based on a very specific underlying trait. So it might look exclusively for value, stocks that appear cheap, or maybe low volatility, stocks that don't swing wildly in price. It's basically a highly targeted approach to capturing market gains. And the absolute powerhouse in this segment, that would be the U.S. Momentum Factor ETF, ticker FDMO. By simply applying a filter that rides stocks that were already going up, it completely dominated. It delivered a massive 14.41% average annual return, turning our 10 grand into over $38,000. It basically crushed almost every dividend and active fund right in its path. Moving on to round 3, the sector ETF champion.
Welcome to the danger zone of concentrated bets, where we find highly focused plays on single, specific slices of the U.S. economy.
But before we crown a winner here, I have to point out a massive trap in the data. Look at the Fidelity Energy ETF, FENY. If you only looked at a 5-year timeline, this fund looked like an unstoppable champion, boasting a massive nearly 24% annual return thanks to the recent oil rally. But when you zoom out to our 10-year reality, it catches the brutal 2014 oil collapse. The result? It drops down to a mere 9% average return, landing in a pretty dismal 9th place in its own sector. Like I said before, 10 years always reveals the truth.
Okay, so the crucial point is finally here. We've eliminated the bonds, the active managers, the dividend chasers, and the factor filters. We are back to our ultimate question from the beginning. Which Fidelity ETF took $10,000 and turned it into an absolute mountain of cash?
Just look at this staggering gap. On the one side, we have our safest asset class winner, the best bond fund Fidelity had, yielding roughly $15,600. On the other side, our ultimate sector winner, dwarfing it completely at over $80,000. That is literally a life-changing $50,000 DAP in capital growth.
And the undisputed champion by pure numbers is FTech, the MSCI Information Technology ETF. It delivered a jaw-dropping 23.19% average annual return. But, and this is a massive caveat you absolutely have to understand, this fund is incredibly concentrated. Just 4 mega-cap tech companies, Apple, Microsoft, Nvidia, and Broadcom, make up nearly half of the entire fund. Every major tech trend of the last decade practically funneled right into these 4 names. So that highly concentrated risk is exactly what drove this enormous market-crushing return.
Finally, round 4, the surprising runner-up. It's time to meet the unsung hero of the Fidelity platform. So there's actually a strange quirk about Fidelity's platform. They don't offer a standard S&P 500 ETF. I know, weird, right? They have a massive mutual fund for it, but not an ETF. So 1Q, the NASDAQ Composite ETF, kind of steps in as their broad market option. And wow, did it deliver. It came in a spectacular 2nd place overall, growing $10,000 into over $54,000. That's a massive 18.46% return, and it is rarely ever talked about by everyday investors.
Let's juxtapose our 2 champions for a second. FedTech is the pure numbers winner. It relies heavily on just 4 mega-cap tech giants pulling all the weight. It's a concentrated, high-risk bet that obviously paid off beautifully. But 1Q? That's what I call the story winner. It generated its massive returns by holding roughly 3,000 different stocks across the entire NASDAQ. It's just an incredibly powerful contrast between a highly concentrated tech bet and a surprisingly safer, broad market approach that still managed to capture massive upside. Which brings us to a final, provocative thought to leave you with. Looking at these astronomical returns, we really have to ask ourselves, was the ultimate winner the FTech fund itself, or was it simply the beneficiary of a once-in-a-lifetime, decade-long tech tailwind? Think about it. If those 4 mega-cap companies stop leading the market tomorrow, does the winning streak end right there with them? It's the ultimate question you have to answer when optimizing your own portfolio. Thanks so much for joining me on this explainer. And remember, always keep questioning the data.